There's a scene in Homer's Iliad where the main character, Odysseus, is driving his ship past some rocks that he knows is home to what are called the sirens. And the sirens basically are beautiful creatures that sing a beautiful song, and whenever ships go by, the crew members hear the sound of the sirens and they chase after them, ultimately wrecking their ships onto the rocks. Odysseus wants to hear the song that the sirens sing, but he knows that the emotional pull of the sirens are going to be too much for him to bear. So what he does is he tells his crew members, fill your ears with wax so they can't hear the sound of the sirens. And he tells them, look, no matter what I do, do not set me free. And so they tie him up to the mast. His ears are open so he can hear the sound of the siren. But as they're passing by, he's hearing it, beautiful song, but he can't do anything about it because he's tied his hands behind his back, and his crew members are deaf, right, by the beeswax, so they can't set him free, and they're not lured by the sirens themselves. So they're able to pass by safely while he's still able to enjoy the sound of the music. So what does this have to do with investing?
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Investing is also full of a lot of different sirens, a lot of stocks, a lot of strategies, a lot of industries that from time to time are basically sirens, right? So the beautiful sound, the beautiful melody of the CNBC.
This is it. I'm going over the top right here. I'm buying the market right here, right now, because I know more than anybody.
Green flashes, up, just tends to allure a lot of investors into investing in whatever the flavor of the week investment strategy is. And a lot of times that siren song ultimately ends in investors shipwrecking their portfolios. So as an investor, one of the wisest things that you can do is recognize your own human infallibility. You are not an emotionless creature, right? So whenever you see a stock price going up, you're going to naturally want to jump into that strategy. And if you know yourself well enough, you can protect yourself against the future yous wanting to do things that you know probably aren't a very good idea. The best way I know how for investors of all types to protect themselves emotionally from the various sirens that the market has to offer is to focus on dividends. So in this video, we're going to talk about a topic that I don't know that many people will cover, which is the psychological benefits of dividend investing. So first of all, why does psychology matter? There's an investment research firm called Dalbar that does a study every year. It's called the Quantitative Analysis of Investor Behavior. So what they do is they look at how investors did relative to how the funds that they would have invested in did. And what they consistently find is that investors do worse than the funds that they tend to invest in. So for example, from 1992 to 2021, so over this 30-year period, the S&P 500 index returned an average, compound average of 10.7% per year. That would be enough to grow a $100,000 investment to $2,082,296. However, investors who bought into equity funds, which would include the S&P 500, their returns were actually 7.1% per year. And keep in mind, this is the 100% stock part of their portfolios. That would be enough to grow a $100,000 investment to just $789,465. And my scale is clearly horribly off, but this nearly $1.3 million gap is almost entirely because of the investor's psychology. When the market was going up, they felt good and they piled into stocks. When the market went down, they got scared and jumped out of stocks and rinse and repeat. This is where I think a dividend strategy really shines. It provides people with an emotional anchor during difficult markets. Here's the price chart of well-known consumer healthcare and staples company Johnson & Johnson. You can see that there's been several periods where Johnson & Johnson has experienced significant drawdowns in their stock price. Keep in mind this is a logarithmic scale. So this tiny little drop here is actually about a 40% decline top to bottom. Then of course you had 0809 when again the stock dropped by about 40%. And then there's several periods where the stock basically just goes nowhere for years and years and years. The challenge with investing a lot of times is just holding on long enough for the stock to ultimately do what you're expecting it to do. Sometimes it takes years, decades even, before that happens. And a lot of times along the way, there's some pretty harrowing experiences. So if all you have to make money in the market is the stock price, it can be very difficult for people to have enough patience to hang on throughout the inevitable tough times. And you can call it a psychological trick or whatever you want to call it, but the fact is that if you focus on the rising dividend stream for Johnson & Johnson, and that is the reason why you own the stock, chances are that you're going to hold this stock throughout this period. Here are the annual dividends paid by Johnson & Johnson over this time, and you can see that each and every year the dividend income increases. Of course, it's a small increase each year, and the overall dividend is pretty small relative to the stock price, but these dividend payments add up, and most importantly, it gives investors a reason to continue to own the stock, basically no matter what is happening to the price. Not only do dividends help investors stick with stocks in bad times, but it can actually shift your mentality to where you cheer for those tough times to come. And I don't mean you cheer for tough times as in people losing their jobs. That's not what I'm meaning at all. But generally speaking, if you're getting big dividend paychecks, you're actually excited when the stock declines in value. And the reason is that you're able to reinvest your dividends at increasingly, or I guess decreasingly, lower prices. So if you have a stock at $100 and your dividend is $2.50, every reinvested dividend will basically get you another 0.25 shares. 0.025 shares. If, however, the stock price were to drop to $50, now your dividend, the same $2.50 dividend, will actually buy you twice as much shares as it once did. So now you can buy 0.05 shares. And if the dividend continues to increase year after year after year, you're going to be able to reinvest next year $3 and then $3.50, all back into buying more stock at lower prices. And not only that, but these reinvested shares that you're buying are also going to pay you more and more dividends. So the lower the price falls, the cheaper you're able to buy the shares, assuming the business is still sound and you still like it at a fundamental level. You actually cheer for stock prices to go lower so you can buy more and accumulate more future dividend income. Dividends also provide you with a tangible savings goal. So most of you watching this video are not going to be retired, you're going to be accumulating for retirement. And one of the great things about dividends is that it gives you a retirement goal that's very concrete and tangible. All you need to do in order to retire is come up with enough income that you don't have to work for. So I guess you could call this passive income, but I think that's an overused term. We'll call it passive. But it does require obviously a lot of active effort to accumulate enough passive quote unquote income. But nevertheless, once your passive income from you doing nothing exceeds your expenses, that basically equals financial freedom or retirement, if you want to call it that. So in order to determine how much dividend income you need to get, all you need to do is calculate how much do you think you're going to be spending per year, and then you just need to accumulate enough stocks that the dividends they pay each and every year are going to exceed those expenses. And once they do, you are officially financially free. Dividends are obviously a fantastic option for people that are already retired. And I think the biggest reason why is that I think it helps people know how much that they can actually spend without relying on the market. So as I mentioned, the 4% rule says that you can spend 4% of whatever you retire with and increase that amount each and every year with inflation, and you will have never run out of money over any 30-year period. The problem with this rule, and really any other that's based on market value, is that it can kind of lure people into spending more when they shouldn't and spend less when they could. So for example, let's say somebody retired in 2008 and they had a $1 million portfolio. So the 4% rule says that they could spend $40,000 per year, and they could increase this each and every year with inflation and never run out of money. Of course, over the next 12 months, the S&P 500 dropped by about 38%. From one extreme point back in October, it actually dropped top to bottom by about 55%. So let's imagine this same exact scenario, only this person decided to wait 12 months to retire. So now they're looking at, instead of a $1 million portfolio, they're now at a $500,000 portfolio. And the 4% rule says that they can only spend $20,000 per year and increase that with inflation. So the reality is most likely somewhere in between, but the problem is that this person might be spending a little too much. This person might be spending a little bit too little, so to speak. But if your focus is only on dividend income, then I think it makes the equation a lot easier because you're not necessarily focused on the market value of your portfolio. You're only focused on what that portfolio can sustainably, and the key is sustainably, produce over the long term. And just because I want to mention it, I will make a note to come back to this QILD question, because I know there's all kinds of people who are going to watch this and say, well, you can just spend 12%, invest in QILD, and we will thoroughly dispatch of that terrible idea in a future video. The other great thing that I think dividends do is they help you focus on the business and not the stock. Ultimately, stocks are simply part ownerships, very tiny ownerships in different businesses. The best investors always think about their stocks in terms of those businesses, not in terms of fluctuating stock prices on a screen. So if you are a dividend investor, you're most likely focused on the profit and loss statement, the amount of dividends that the company is able to sustainably pay back to you, which inherently puts your attention on the things that you should be focused on in the first place. Dividend stocks also tend to be more stable businesses that have been more established over the long term. So they tend to be less volatile businesses with more stable cash flows, which naturally translates to less volatile stocks. For example, Procter & Gamble makes all kinds of different things, basically that you need every single day, right? So you got Pampers, you got Charmin, toilet paper, Gillette, razors, there's toothpaste, batteries, all kinds of things that basically no matter what happens, you're going to always need and buy these things. And as a result, businesses like P&G and other dividend stocks tend to hold up better in bad markets. So for example, this is through November 17th, 2022, you can see that the S&P 500 has generated a loss this year of negative 16.5. Meanwhile, the Vanguard Dividend Appreciation Index, which is a basket of stocks that have raised the dividend for at least 10 consecutive years, just a general proxy for dividend growth strategy, is down 9.5%. You also see it back in 2008 when the S&P 500, like I said, dropped 50%, actually dropped a little more than that total top to bottom. But over this same time period, the dividend strategy dropped by just 42%. And it may not sound like a lot, but this difference between 42 and 50 is actually quite significant. Every percentage that the portfolio declines requires an even larger percentage to make up for the difference. So while I think dividends are a powerful strategy for financial purposes, I do sincerely believe that companies that pay dividends tend to reward shareholders more than companies that do not pay dividends. Now, there are exceptions to that. I don't think it's necessarily always that dividend stocks are superior. There are examples of businesses that should not pay a dividend. So Berkshire Hathaway is a classic example, but those kinds of businesses with those kinds of managers are very few and far between. So I think most investors would be better served and stay away from a lot more trouble to focus on dividend stocks. I think it offers you a psychological benefit that other strategies just simply cannot match. I think even if you said, Nathan, QQQ is going to outperform dividend strategies over the next 30 years, I still think the actual returns realized by actual real life investors would be greater in the dividend strategy because you wouldn't have as many ups and downs, and you would have some of those psychological anchors that would help people stay invested throughout. So anyways, I think there are a lot of merits to dividend investing, but one of the most underrated is the psychological benefits, the psychological effects that it can have on you and helping you relax while you slowly but surely grow wealth over time. Thanks to everyone who is currently supporting me on Patreon and YouTube Premium. I really appreciate your support. I don't make much money at all from YouTube ad revenue, so that really helps me supplement that income and help keep this channel going. If you want another way to support the channel, you can check out my Valuation Course. I'll post a link in the description below. It is currently on a beta test, which means you're able to get it at a discount, and you'll get access to all future videos that I add to the course for no additional charge. Every time I add about an hour worth of content, I'll probably increase the price of that course by $30 to $50 per hour. So if you want to get into that course now before the prices go up, like I said, I'll post a link in the description below. Thanks for watching, and I will see you in the next video.